Okay, I think we're ready to get started here. So hello to everybody and welcome to our Business Growth Tools webinar. Thank you so much for joining us today. My name is Matthew Litke, Entrepreneurship and Square One Coordinator with Economic Development Regina. For those who aren't familiar with WESC empowers female entrepreneurs to start, grow, and scale their businesses. WESC has a ton of different services to help you on your journey, including business advising, financing, events, and training. Right now, they are offering free webinars every Wednesday on a variety of different business topics. The webinar today is part of WESC's Business Growth Luncheon Series, which is offered in partnership with the NSBA and Economic Development Regina. Our topic is tax considerations for entrepreneurs and is presented by Lori Hudima, partner in Virtus Group's Regina office. Lori is focused on leading the firm's tax committee. So if you have any questions for Lori as we go throughout the presentation, please submit them in the Q&A box, not the regular chat box. And as always, this webinar is being recorded and will be available for on-demand viewing. You'll receive an email tomorrow at this time with a link to the recording. And with that, thank you, Lori, for joining us for today's webinar. Please begin when you are ready.
Hello, everyone. Welcome, everyone, to this presentation on tax considerations for entrepreneurs. As Matt said, I'm Lori Hudima. I'm a tax partner here in our Regina office. We have three offices, one in Estevan, one in Regina, one in Saskatoon. And I specialize in tax and tax restructuring for my clients. And personally, I have three beautiful daughters and three beautiful granddaughters. So they keep me relatively busy on my spare time. So we'll get started on our presentation. There we go. So the agenda for today, the plan is to go over the taxation of different business structures, acquisition of business, because not all companies start from scratch. Sometimes business is acquired. Reorganizations, tax implications of financing options, overview of certain COVID-19 programs that are going on right now, and then just a closing question and answer. So I'll try and answer all your questions near the end of the presentation, and we'll go from there. So what's a startup business? So it's defined as a business in operations for 3 years or less. So over half of new startups are run on a part-time basis. So usually a person starting up a business doesn't need some financing, and usually they're working while starting up their business. Average entrepreneur starts with seed money of less than $5,000 or of $5,000 or less. 32% of startups are usually tech-based. A lot more of that's happening, I guess, now with COVID and everybody isolated at home. Solo-run businesses with no employees accounts for over half of the total businesses in Canada. So a lot of entrepreneurs running their business without any additional employees, and usually not paying themselves during that startup time. So types of business structures, we're going to cover off three structures: sole proprietorship, partnership, and corporation. There are other ways to run a business like joint venture structures, but these three are the main that we would see. 99% of the businesses are run in one of these forms. And you might start off in one form and transition to a different structure. So the next slides will go over these three types in more detail. So sole proprietorship is the simplest way to start. You can be simply as using your own name and an existing bank account and start the business. It's obviously least costly alternative. You usually don't need to hire a lawyer to file any documents. Don't have to have a separate bank account if you operate under your own name. although it's always encouraged to keep your business records separate from your personal records. Net income for your fiscal period gets reported on your personal tax return. So fiscal periods can't be more than 12 months, but might be shorter if you just started in the year. And usually year end is December 31st. Maybe tax is an advantage to when you're doing startup. You might have startup losses to utilize. So this can be a way for forming your business as a proprietorship. You can deduct those losses in your business against other sources of income, for example, your employment income. Risk in a sole proprietor is, I guess, in that your personal assets are at risk because your business is basically mixed with personal assets. So if your business is sued, you may lose personal assets if you lose the lawsuit, versus a corporation, which is a separate legal entity from yourself personally. You may need to register your business. Most likely have to register provincially for PST, federally GST. If you operate a business other than your full name, you need to register that business name. The registration would be done provincially. Warning, if you are using a business name other than your own name, you will likely need to open a bank account in that name to deposit checks too. Business name registration applies to sole proprietorships, partnerships, and corporations though. Importance of the federal business number, it's basically a single account with Canada Revenue Agency for dealing with federal government taxes, payroll, import, export, GST, those sort of things. Note, self-employed Canadians can now register to be eligible to receive EI benefits as well, special EI benefits, including maternity leave, parental leave, sickness, and compassionate care leave. So they would just have to register through Services Canada. Partnership is defined as a relation that exists between two or more persons carrying on a business in common with view to a profit. So if you never expect to make a profit on a business, for instance, maybe it's more personal in nature, you really can't form a legitimate partnership because you have to have the expectation of profit. Partnership agreement is strongly recommended. Among other things, it details how profits and losses will be shared, because obviously a partnership is just not one individual, it's between more than two or more individuals. And you might be agreeing at the start of the business, but oftentimes you find down the road as things become more profitable, there becomes issues. And so doing the partnership agreement up front just avoids those issues down the road while you're still reasonable with each other and talking. All income and losses are flowed out to partners who report their share of partnership income on their tax return. So if they're a individual person involved in the partnership, they report it obviously on their personal T1 return. If they're a corporation, they report their share of the partnership income on their T2. If they were a trust, they would report their share of income on their T3 return. So partnerships themselves do not file an income tax return or pay income taxes. But CRA does have requirements for certain partnerships to file an information T5013 return, which are due end of March if the partnership has a normal calendar year end. So the rules are if at the end of the fiscal year the partnership has revenue plus absolute value of expenses more than $2 million or has more than $5 million of assets, they'd have to do the T5013 filing. Or if at any time during the fiscal year the partnership is a tiered partnership where the partnership is invested in another partnership. We don't see that too often. The partnership has a corporation or a trust as a partner, which it happens quite often. The partnership is invested in flow-throughs, or if the CRA in essence requests one. Corporation, the third structure option that we're going to discuss, is a separate and distinct legal existence from its shareholders. So usually ends in limited or corporation or incorporated or LTD or INC. Most costly to set up and administer, can incorporate either federally or provincially. Usually you only see incorporating federally if you plan to operate throughout Canada. If your plan is just to operate in Saskatchewan, you just incorporate provincially. If down the road your plans change and you want to move into Alberta and have office in Alberta, you can always continue into Alberta with the same corporation, so it's no big deal. If you're not going to use just the numbered company corporation, but want a specific name for the corporation, you'll have to do a name search, which will be required to make sure that no one else has that name, that you can use that name. Obviously, incorporation, you're required articles of incorporation, bylaws, shareholders register will be required. So often it's best to look to lawyers to help you with the corporation to make sure everything's set up. We do some restructuring after the fact of people that have incorporated themselves, and we have to get the lawyers involved to amend their articles, because oftentimes they'll just have one class of articles and might not completely be set up properly. So although you might avoid costs setting it up by yourself initially, if down the road you become successful and want to get structured properly, it probably required some additional legal fees to get that fixed. Administration costs include bookkeeping and accounting. With filing the corporate tax return, they do have to prepare full financial statements, GIFI, which is the balance sheet and the income statement. If you're a proprietor, you would just report your income statement, in essence, your profit and loss. You don't have to worry about the balance sheet. But with the corporation, you do have to be concerned with all those. Accounting fees will also be higher than sole proprietors, because advice and action is needed not only for the corporation tax planning, but then the personal planning to get the money out of the corporation and into your hands personally. Definitely certain tax advantage, especially when you're going in growing the business and paying off debt. Maybe if you can leave the profits inside a corporation and you're eligible for the small business deduction, which most corporations are, your tax rate inside the corporation has actually been dropped as of September 30th, 2020 to 9%. 9%. So the federal rate is 9%, and Saskatchewan actually reduced its rate as effective for year end starting September 1st, 2020 to 0. So the total tax on income eligible for the small business deduction is 9% now for Saskatchewan. Is planned to go back to 11% in the next couple of years, but for now we can take advantage of that low rate. Even at 11%, it's pretty low tax rate. The small business limit across for federally is 500,000, but Saskatchewan actually allows up to 600,000 at the low Saskatchewan rate of 0%. So there's often some planning that we'll do if we can maximize that, even up to 600,000 of taxable income in the corporation. So when you pay yourself out of corporation, you would be taxed on after-tax income as a dividend out to you personally. So if you paid the low rate of tax, you'll pay other than eligible dividends out to yourself personally to fund, or you can take money out as salary, and then any salary paid out of the corporation would be an expense to the corporation. The advantage of corporation structure is legal protection, because it is a separate entity from your personal assets. You can select any month year end, no matter what your corporation's year end is, though personally any dividends or salaries you take out of the corporation must be reported on a calendar basis. And the corporate tax return is T2, which is needs to be filed within 6 months of the year end. So if you're not a startup business, you decide to acquire a business instead, one of the key questions that you should be considering is whether you're going to be buying shares or buying assets, because it makes a big difference to what your tax rates and the complications of the whole thing is, and what you're actually acquiring. So typically a seller will prefer to sell shares because there's what they call the capital gains exemption if it's a qualified small business corporation, where they can get up to 860, it's almost 900,000 now, on selling their shares and claim a capital gains exemption to offset that gain. The buyer will want to purchase assets, because if you buy shares, you can't deduct, there's no deduction for the cost of the shares. But if you buy assets, so increase the cost base of assets, you get to depreciate those assets for tax purposes. So definitely a buyer wants to buy assets and the seller wants to buy shares. So oftentimes in negotiation, you work out a deal where if you're looking at whether you're buying shares or assets, the price is not the same depending on which way you're leaning towards. So acquisition of shares, some of the cons are obviously if you buy a company where majority of its asset is internally created goodwill. So let's say who you're buying this company for started this business and created a huge business that has lots of goodwill. So the tax basis in the corporation that they have on that goodwill is zero, because they never paid anything for it. They just created it. So if you buy the shares, you just have, let's say you buy the shares for 500,000. Again, you have no deduction for the share price. You hopefully sell your shares later on and get to use that 500,000 you paid for the shares. But if you bought goodwill itself, the assets, you'd be able to depreciate the cost of the goodwill. So if we go to asset or acquisition of shares, there's a few other implications when you buy a company from an unrelated person. There's a few implications. So the day you acquire the business, you take over the business, there's a deemed year end. So the seller would report any income up to the date of sale and pay the tax inside the corporation. Capital losses are lost. So we'll often do some planning if there are some capital losses in the corporation, but have some assets that have accrued gains to work with the seller to realize the gains on some of those assets to use up those capital losses, because after you buy the shares and take over, you'll have no capital losses to utilize that were incurred before the purchase of the shares. And then non-capital losses are restricted. So what this means is basically Canada Revenue Agency or the government wants you to continue the business with the intention of creating a profit to utilize those non-capital losses that are within the business. So you got to watch if you're buying a corporation just because it has some losses in there, to make sure you discuss with someone in the tax area to make sure they are actually able to get access to them. With acquisition of assets, it's a little more complicated because you got to go through, even the purchase agreement is more complicated. You got to go through all the assets and figure out what asset is going to be sold at what price and that sort of thing. And then there's also the PST and GST implications as well. So it creates a little more work for the lawyers into creating that purchase agreement, making sure all the assets that you're going to acquire are accounted for, and then how you're going to allocate the purchase price to those assets. Obviously, the seller wants to put as much to value to assets that are going to result in a capital gain to them, but put as little to those that will end up having a recapture depreciation, which is fully taxes, versus capital gains right now are basically only 50% taxable. Half is included in income and this half is not taxable at all. So we'll talk a little bit about reorganizations once you have your business running and different things. The topic reorganizations is so broad, but we'll try and focus on those that an entrepreneur will come across in initial stages of business. So with an entrepreneur may decide to commence their business in a partnership or sole proprietorship basis so that they can use startup losses, as I said before. So once the business becomes profitable and generating more cash than that you need personally to run the business, so it means that you can leave more cash inside a corporation. That might be the point where you want to look at incorporating your proprietorship or incorporating the partnership. So we can do those on a tax-free basis using Section 85. We can incorporate those for the most part on a tax-free basis. There's certain things you got to watch out for when doing the roll into the corporation. For instance, you can't transfer land or real property inventory. So if you are starting a business where you're going to do a land development business, we're going to develop some land and flip it. That's real property inventory. So the problem is you can't start that out as a sole proprietor or partnership and then roll it into a corporation on a tax-free basis, because the Act doesn't allow us to do that. There is some workarounds with maybe rolling it to a partnership and then later on to a corporation, but that'd be something you talk a little more complicated than this webinar would have time for. So then there's also some tax motivated reorganization. For instance, if you want to access corporate losses, you've got some capital losses or non-capital losses you want to utilize and have maybe an asset that's held outside that has a accrued gain that you're looking to sell maybe later in the future. We might roll that asset in and then sell it inside the corporation to use up those losses. Or if we've got losses in between two different companies, there'd be some structuring that we might want to take to use up those corporate losses. We also want to make sure with reorganizations, if a company has been running the business and highly successful and they built up some cash and investments inside the operating company, that maybe we look to crystallizing the capital gains exemption down the road. So we want to move out some assets into a holdco, maybe crystallize the capital gains exemption if we think down the road that the government will take that away. Highly unlikely, but there's always that option. Or we've crystallized the capital gains exemption on shares if we know we're going from an active operation to inactive operations. We might want to crystallize it. Purifying the corporation to retain its eligibility for a small business corporation is a big one. That's where you've got tons of cash or investments inside an operating company. Not just for purifying, but on the next slide, I'll talk a little bit about creditor proofing as well. If we have departure of shareholders, we may require some restructure to get the right ownership after they leave, or reduce the tax implication as for the departing shareholder. There's some structure we can do. Breakup of a corporation, and we see this lots, unfortunately, with divorces, but also see it with siblings that have inherited business from mom and dad and tried running it together. Mom and dad were quite successful at their business, but the siblings, not so much. It's a little harder to deal with siblings and that give and take. So oftentimes we're breaking apart corporations because of siblings just can't work together. There's also estate planning reorganization. So if mom and dad are getting up there in years and have enough wealth for their retirement, and the kids want to bring their kids into the company, we often will do what's called an estate freeze to freeze the value of the company in fixed value preferred shares, and then the kids are issued common shares for nominal consideration because all the value is tied up in those fixed value pref shares. This allows the future growth to now go to the children. It fixes the parents' estate value in the preferred shares, which we will reduce by redeeming some shares every year as they need excess cash out of the corporation. Creditor proofing I touched a little bit is along with the purification thing that we do, just involves probably setting up a holding corporation to remove excess cash or investments out of OpCo into a separate holding company. And then creating a structure so that we can easily get excess cash over to that holdco as needed. And then finally, transferring ownership to employees. So owners of business want to give equity ownership sometimes for retention purposes. I usually try to dissuade owners from doing this, as there's other ways that we could look at, such as phantom shares or bonus plans. But if this is their succession plan, is transferring to employees because they don't have the child or children that want to take over the business, then we would look at some restructuring options to bring in key employees. Tax implications of financing options. So very, very short slide. Basically, if you take loan to help with financing, the interest on the debt that individual or corporation or a partnership has is deductible for tax purposes, or in the calculation of the partnership income that's going to be allocated to the partners. Oftentimes, an entrepreneur, especially during the startup side where we don't have the established business and other assets within the corporation, would have to provide personal guarantees on the obligations of the corporation. Equity investment does not give rise to a deduction, and what would happen is you might have someone in your family give them some pref shares with a dividend entitlement. So there's no interest deduction, obviously. The dividends are paid out of after-tax income, so again, no deduction for them, and the individuals would just pay on the dividend that they receive. If you're paying dividends to a corporation that is connected, what they call connected, which basically means they own 10% of votes and value of the dividend payer or related to the dividend payer, then those dividends going between the two corporations would be eligible for a deduction and shouldn't have to pay any tax unless we have refundable tax implications. So going into some of the wage / rent subsidies for business that are out there right now due to COVID, we're just finalizing our T4s. So this temporary wage subsidy that was in place gave you 10% of eligible payroll paid during March 18th to June 19th. You could claim it as long as you were even an individual, a Canadian-controlled private corporation eligible for the small business deduction, a partnership, a non-profit organization, or a charity. and had an existing payroll account as of March 18th. That was all the requirements you needed. So if you're in the case where you did have payroll between March 18th, actually paid between March 18th and June 19th, and you haven't claimed this yet, it's not too late. You can still claim it. They will actually, if you obviously didn't reduce the tax portion of your payroll remittances, we can still file this PD27 form and and claim that 10%. And just ask for it as a refund, or you can apply it to 2021 payroll remittances. Anything that you get on this obviously is taxable. So that's one that's not too late to claim. The Canada Emergency Wage Subsidy, I'll call it CEWS. I'm not sure. There's a different wordings how people say this. I heard CEWS and CEWS, but I'll refer to as CEWS. So this provides eligible employees a wage subsidy for wages between March 15th and June 2020. So it's wages paid in relation to earnings from March 15th, 2020 to June 2020. And what it means is it'd be wages you've earned between that period, but to make the claim, you also have to have paid them. CEWS, again, is taxable in the year received. And to be eligible, one or more eligible employees have a payroll account as of March 15, 2020. They did bring in where you were using a third-party payroll provider. As long as we can get their payroll, that third-party payroll account that they have for you, split up and put into a payroll account of your own business. And you now continue to do payroll deductions on that account going forward. We can still get the CEWS done for clients, and we have done that for clients, or suffered a drop in revenue. Quick. So this started March 15, 2020, and they're 4-week periods. So periods 1 to 5 must have been filed by February 1st, 2021 was the last time you could file periods 1 to 5. And period 6 is due tomorrow, February 25th, 2021. All period 6 are due tomorrow. So if you haven't done it, there's still quite a few more payroll periods or CEWS periods that are coming up, because this is going, the period 6 one is for August 2020, in essence, wages, thereabout. So this program is planned to go till June 2021. So there's still quite a few. So if you haven't looked at this, I would suggest looking into it. And if you do need help, don't hesitate to give me a call. We've got a team here that has been we've got almost 300 clients that we do their CEWS filings, CERS filings, and temporary wage subsidy filings for, helping them out, because it isn't an easy read of the legislation a lot of the times, understanding these rules. So now there is a new Canada Emergency Rent Subsidy, which was backdated to September 27th, 2020. So there's lots of time to still apply for period 1 of this subsidy. I think we have until end of April or end of May, sometime in there, to do the period 1 CERS claim. But this allows you to claim expenses for rent expenses capped at $75,000 per location, up to $300,000 amongst affiliated entities. So quite a large benefit that can be obtained if you qualify. So if you're a renter paying amount to arm's length parties and running a business, you'd be eligible for this if you've got the revenue reduction. And the revenue reduction, I'll talk a little bit more a little later, but it's basically parallels the CEWS revenue reduction calculations as well. So if you're renting from an arm's length party, you'd be eligible to claim. The eligible expenses are base rent, contingent rent, the amounts that you might, under the old rent subsidy, that CECRA, that Canada Emergency Commercial Rent Assistance Program, if you and your landlord had applied under that program, anything that the landlord would have got on that is technically the rent you paid them. That so those expenses would qualify. And then if you have a net lease where you're paying, your share of property tax, insurance, and whatever else they list in there, those would be eligible expenses. Specifically, though, it excludes sales tax, cost of damages, interest and penalties are the common ones we see that we can't deduct. If you're a property owner, so it's misleading because it's called rent subsidy, but if you're a property owner that uses the property that you own in your non-rental activities in the entity, or you primarily rent the property to non-arm's length parties or related parties, then you can also make a CERS claim if you've got the proper revenue drop. So in this case, property owners can only claim insurance, property taxes, and mortgage interest with hyphen or star beside interest. Obviously not principal payments, but to deduct the interest, it must be the lesser of interest calculations as if they were calculated on the building, the lowest principal balance on the property's mortgage since it was acquired, the cost amount of the property. So what this means, it basically is if you have the original mortgage on the property that you've continued to pay down, you'd be able to fully deduct the interest, or it'd be part of the eligible expenses. But if you had remortgaged the property, it's only the initial interest on the initial mortgage that would be qualified expenses for the CERS. So again, just like the Qs each period is a 4-week period, the CERS are each a 4-week period, and period 1 CERS aligns with the same dates as period 8 Qs, the way they have it working. The applicant must have either paid the expenses or will pay the expenses no later than 60 days after the payment of first subsidy. So what does this mean? So if you have, let's say, property tax is a good one to use. So if in 2020 the first periods start September, or basically most of October, November, December. So periods 1, 2, 3 all fall 2020 periods. So what expenses did you pay in relation to those 4 weeks periods, or have for those 4-week periods? So it's not when the expense was paid. It's if you have a year's worth of property taxes that was paid June 2020, 4 weeks of that year's worth of property taxes can be claimed on period 1 CERS. The issue we're going to run into is come period 4, where we're looking into 2021 and we're looking at property taxes. We might have a business where they don't pay their property taxes until June 2021. So that's well beyond the 60 days after, like if we filed period 4, right when we can initially claim it, the June 30th will be well beyond the 60 days. So what it means is they can, our clients can continue to pay property taxes June. It just means we won't be able to file the period 4 CERS claim for them until end of April, beginning of May sort of time frame, and then be within that 60-day period. The reference periods, like I said, for the CERS is period 1, which follows period 8's Q's claim, September 27th to October 24th. And the general approach when you're looking at the revenue reduction is obviously you've got to follow Q's first. So if you've been claiming Q's and your Q's is calculated on comparing the prior year figures, looking at 2019. So we're looking at October to 2020 to October 2019 for Qs, we got to do the same thing for SIRS. We have to look at October 2020 to 2019 or September 2020 to September 2019. We can't use the alternative approach, which is average of January and February 2020. So if you're filing Qs looking at the prior year, 2019 numbers, you have to do the same for SIRS. If you don't have Qs and you're going to file SIRS for the first time, you can use either the general approach or the alternative approach. We have that option. So these are the first 3 periods, and like I said, the legislation is set up to authorize us to go to June. That is set up so that it could allow this program to go to June 2021. So quite a few number of months to go yet and get these done. But you're better off looking at it earlier than later because there are deadlines. Okay, and then back here for a sec. So yeah, so revenue will be calculated in the same manner as Qs, and I'll go over kind of the revenue alternatives or elections that can be made under Qs/SIRS. So the prior period reference is the one that we already discussed in that previous slide. Consolidated financials just says if you have a group of companies and you prepare consolidated financial statements, you can prepare do your revenue reduction based on those consolidated financials. But if you have a group of companies that you're consolidating, in that case, they all have to do the revenue reduction on a consolidated basis. You can't have one do it on consolidated basis and the other one do it on non-consolidated basis. The affiliated groups is an election to determine revenue on an affiliated basis. And what affiliated means is basically you're affiliated to a spouse, not your child, and you're affiliated to corporations that you control or corporations controlled by corporations. So it's a little narrower definition. So definitely if you're looking at alternatives, it'd be good to talk to a tax person in regards to is that an option to get more entities qualifying. So we have done this for some of entities, and we don't have to, like, we could do affiliated for period 1 and not do affiliated for period 2, and you can switch periods to periods. So it's worked well where we've got employee wages in a corporation or a couple corporations, and one qualifies and the other one doesn't. And doing it on affiliate basis, we got both companies qualifying. So it has worked well. Joint ventures just talks about if you have 90% of your revenue is from a joint venture, you can just look through. Intergroup service providers, again, is if 90% or more is coming from a non-arm's length related party, then you can just look through and use that related party's revenue. If you have multiple non-arm's length parties that you're getting revenue from, there's kind of a weird formula-based calculation to do that look through. We've got template here that can help you if you need to do that. Cash method. So if you filed any Qs already, periods 1 through 5 or 6 or any of them, you're stuck with whatever initial method was picked for all periods. So if you picked cash basis for period 1, you've got to do cash basis for everything for both Qs, SIRS for all periods. There's no option. And what cash method or rule is, basically you're making an election. If you normally prepare your financial statements, which majority of businesses do on accrual basis, then you elect to determine your revenue on a cash basis. If you don't want to go cash basis, then you have no election made. If normally report on cash basis, which would be a lot of farmers report on cash basis, then you can elect to use accrual basis. Okay, so that is my presentation. I'm not sure if there's any questions anybody has. So Kathleen just said, my understanding is even if you're incorporated, your personal assets can be at risk regardless of the incorporation. You're no longer actually, there's, I mean, similar, there is still some protection with corporations over personal. I guess it depends if what kind of liability was incurred inside the corporation. If one incorporates in Saskatchewan, but through online sales ends up distributing throughout the world, where should one be incorporated? Like I said, you can continue into different locations. If you're going to incorporate in Saskatchewan, but then you're going to be selling, let's say, to the US, you can stay incorporated in Saskatchewan. You would then just have to watch out to see if you got any what they call nexus or permanent establishment for US purposes, which would cause you to have to file tax returns, state returns, or federal returns in the United States. So yeah, you can stay in Saskatchewan. What if one is not renting but will rent? Will one qualify for subsidies? Not the SERS one, because you had to have basically been renting as of September 27th when this was brought in to qualify. You must have an agreement. If a company was working on a restart or gear up when the pandemic hit, they won't have any previous revenues to go off. Yes. Yeah, unfortunately, unless you got the January, February, you can always compare the average of January and February 2020 for your revenue reduction analysis. So hopefully that would work for it, but otherwise it makes it quite difficult for those programs. Okay, I think that's the end of the questions. So thank you very much.
Oopsie. I think there are more questions where people are putting it in the chat box. A question from Ty reads, for the CEWS, can the employee who owed more than 40% apply for it?
What was that?
There's some extra questions, but they are in the chat box instead of the Q&A box. And one of the questions from Ty is, for the CEWS, can the employee who owed more than 40% apply for it?
The employee apply for it?
Yes.
The Q's is for the that owns more than 40%. Yes, you can. If they're talking about an employee related to the business, I guess, that owns more than 40% of the business. Yes. Employees that are related to the business or own the business can still apply for Q's for their wages, but the key with them is they need a baseline wages, which there's different options. So with the periods that are in effect right now, there need to have been wages paid to that employee from either January 1st to March 15th, looking at what was average weekly pay at that time, or if they didn't have any wages at that time. We've got some employees that only pay themselves once a year at December, right? So with the periods that now we can still qualify for, period 6 on, you can look also at wages paid from July 1st to December 31st, 2019 as their baseline. So as long as employees related to the business have a baseline, either paid wages December or July 1st to December 31st, or paid wages January 1st to January 1st to March 15th, we've got a baseline that we can use so they qualify for the RSQs.
And then one more question from another person, and this one reads, what's it say?
So now,
How much loan can a sole proprietor business have?
how much loan can a sole proprietor business have? See, really, I guess you could have as much as you want, because typically the banks are going to ask for personal guarantees anyways. If down the road we want to roll this sole proprietorship into a corporation, if we got not enough assets and too much debt, we're either going to create a tax impact when we transfer it in. We won't be able to get all the debt inside there without creating some tax to the individual proprietor. But if you continue to operate a sole proprietorship business, really it's up to whatever the banks are willing to lend you. And you got to make sure that to deduct the interest, it was used for your operations. Like you got to prove that, you just didn't take it out to pay your, use it for personal funds or whatever.
Well, thank you so much, Laurie. That was an excellent presentation, and I don't think there are any more questions. Thank you for all of those who took time out of your busy days to join us. Don't forget to check our event page at west.ca/events to register for our upcoming webinars. And I will just end the presentation. Oh, I think there might be one more question.
So you had left a message yesterday, or was it the day before?
Kate asked, as a sole proprietor that was just launching when COVID hit, I had more costs than revenue in 2020. How do I report this on my tax return?
Oh, well, on your tax return, you'll be reporting on a business schedule, and you'll end up having a loss. So hopefully you've got some other personal income to use up those losses on your personal tax return. So whether you've got interest or T4 revenue before you started your business or something, that you can use up those losses. If you create a negative income, taxable income, which I've never seen, but I guess it's possible on your personal tax return, you can actually carry that loss back to a previous year. But usually we don't want to have our sole proprietors end up that way. So we want to be able to use those losses against other sources of income, whether they pull out RSPs or whatever they have to do to create some income to use up those losses and their base exemptions. Like you don't want to, you can get almost $20,000 without paying any tax on it. So we want to make sure we use up those instead of trying to create negative taxable income on a personal tax return.
Oh, thank you so much. I think that's actually now the end of the presentation. And everyone have a wonderful day.